We're going to learn about cash flow. We're going to learn the three categories in the cash flow statement. We're going to learn and remember how revenue is different than collections, how expenses are different than payments. We're going to talk about the direct versus the indirect method of presenting operating cash flows. And we're going to understand the source and nature of the reconciling items in the indirect method presentation of operating cash flows. Then we're going to show how the same transactions are reported in the income statement and the cash flow statement. So let's get started. The cash flow statement sorts the activity in the bank accounts into three categories: operating, investing, and financing. Operating has probably 95% of all the activity because that is the day-to-day activity. Payments are made, collections from customers, more payments, more collections all day long. Investing tends to be multi-year large things, such as buying a new building, buying a subsidiary. Those are infrequent but very large transactions. Financing are getting and repaying loans and transactions with owners. Those also tend to be sparse but large and impact many periods. So these two are large multi-period impact items that happen infrequently, but they're large in dollar amount. Most of the activity is in operating. So there's only two things in investing and two things in financing. So I usually ask students just to remember those, and then everything else is in operating. So investing is buying and selling of long-term assets, never inventory. Buying and selling of securities, stocks and bonds in other firms. Financing is getting or repaying debt, and any transactions with owners, like issuing stock, repurchasing treasury shares, paying a dividend. Everything else, all payments and collections from core operations, paying of salaries, travel, supplies, collecting from customers, and so forth. Interest payments are considered operating activities, even though they're non-operating on the income statement. They are operating on the cash flow. So take a shot at it. So how'd you do? Dividends, financing. Inventory, operating. A stock dividend being declared is not a cash transaction. There was no payment made. Issuing paychecks is operating. Issuing stock, transaction with owners, that's financing. Collecting from a customer, operating. Buying treasury stock, that's repurchasing shares, that's a transaction with owners, that's financing. And selling warehouse, that's a long-term asset, that would be investing. So here we have 6 different companies, and notice that they all have identical net cash flows. Are they equally successful? It turns out that cash flow in each of the 3 categories are not evaluated in the same way. The most important one to be positive is operating. So if your collections from customers are not enough to meet the payments that you need to make to employees and vendors, you're in trouble. So these firms that have a negative operating cash flow, especially if it's more than one period, would be weak. Now for investing, a negative investing means that you're buying more assets than you're selling, and that could represent growth. So a negative investing can be positive. In fact, a positive investing means that you're selling off a bunch of assets, and that sometimes could be an alarm. If you're having to sell assets to repay debt, that could be that you're in trouble. So a positive or negative here is not necessarily the same thing as a positive or negative with operating cash flow. In financing, a positive means that you are issuing stock and you're getting loans, so you're gathering capital, hopefully to grow and invest in long-term assets. And a negative may be that you're paying dividends, or you're able to repay debt, or able to repurchase shares of your own stock. And that can be positive, meaning that you have extra cash that you can use in that way. So the only line here that is a real signal in terms of worry is the operating cash flow. That does need to be positive. Alright, so that's how to interpret the cash flow statement. Now let's look at constructing one. The operating cash flow section, as opposed to the financing investing, the operating cash flow section can be presented either using the direct method or the indirect method. Notice that they both have the same net operating cash flow, so the change in the bank account is the same no matter how you wish to report that change. The top one reports all the deposits and all the payments, and it ignores what's been reported in net income. In the bottom one, it takes net income and it reconciles back to the cash activity. So it makes adjustments for things that are in net income that never hit the bank account, or things in the bank account that never hit net income. Investors like to see why you didn't collect everything that you earned, or why you didn't pay everything that you incurred. So the indirect method is the most frequently seen presentation on cash flow statements. Why do we have adjustment to the net income? Net income is not cash. Remember that you can collect before, at the same time, or after you earn, and you can pay before, at the same time, or after you incur expenses. So revenue and collections, when they differ, which is frequently, there's a reconciling item between what's in net income, which is revenue, and what's in the bank account, which is collections. Expenses are what's in the income statement, but payments are what's in the bank account. So when expense and payments differ, which they often do, you will have a reconciling item between net income and what's in the bank account, your operating cash flow. So when you're creating an indirect presentation, basically you're going and finding all the places that expenses and payments and revenues and collections differed. So let's do a few. Let's say that a firm invoiced customers $250,000, so that's sales on credit. And they also, in the same period, collected $200,000 from customers. What will the income statement show? It'll show the $250,000 invoiced. What will the cash flow statement show? That's going to show collections. Where is the difference going to show up? That will be a reconciling item between what went in net income, which is the $250,000 revenue, and what went in the checking account, which is the $200,000 collected. The ending balance in accounts receivable is going to be higher based on billing $250,000 and collecting $200,000. So whatever the beginning was, the ending is going to be $50,000 higher. So in the second part of this lecture, we're going to practice another 5 or 6 times with different accounts this pattern of looking at the difference between what's in net income and what's in operating cash flow.